Hello everyone, welcome back. I got some really good ones for you today on this Wednesday, January 15th, 2024. A lot's been going on with the markets. That's what we're going to be focusing on for today's video. So welcome back, glad you made it, and let's dive right into these markets, shall we? So first bit of drama going on with markets this week has been that rising 10-year yield. We've been talking ad nauseum in this channel about how if that 10-year yield were to rise above 4.5%, it would start to put a lot of downward pressure on our bags out to the end of the risk curve, like tech stocks, NASDAQ, energy, gold, Bitcoin. You know, those things would get beaten up pretty good if that 10-year yield kept moving up. It has. 10-year yield above 4.5%, took a run for 4.8% yesterday. That was pretty freaky stuff. We start to run into problems with the entire global economy at a 5% 10-year yield. So yesterday, I was buying the dips and really hoping that the Fed would step in or somebody and start buying bonds, driving those bond yields back down towards 4.5%. And today, guys, we saw that we've had a little bit of a relief rally for markets today. We have the 10-year yield falling from 4.8% yesterday down to 4.65%. So we see that 10-year yield coming down 12 basis points in a day. That's good. We see the NASDAQ really liking that, leading the way, going up about 2.5% today. VIX cratering, so that volatility cratering about 15%. Dollar down just a little bit, with gold up modestly. Silver up a little bit more than gold, so the glove fits there. Energy moving up. Bitcoin flirting with 100K again. So perfect risk on day, you guys. You had yields come down, rates come down, dollar come down, NASDAQ lead the way. The other two major stock indices, the S&P 500 and Dow Jones, following suit, but not performing as well because they're not quite as volatile and yield and rate sensitive as the NASDAQ. So really a pretty textbook relief rally today after a little bit of carnage yesterday, guys. So I was in there buying the dips. We saw Solana fall to like $1.72 yesterday. Probably stopped out every trader for the Solana chain that's using stop losses. Guys, I don't use stop losses, so there you go. Never, I used to, but I found out if you use stop losses, the market has a tendency just to chop you up and take you out of the trade. So I'm sure a lot of traders yesterday were, in the last week, were buying into Sol at like 210, putting a stop loss at 204, getting stopped out, buying in at 201, putting a stop loss at 198, getting stopped out. You know, those bots, those algorithms, those proprietary high frequency trading algorithms that like Goldman Sachs use, you know, they can see your stop losses too. So they like to run those stop losses. And then as the trader has been stopped out 10 times and is staring at the wall, feeling pretty, you know, down about himself, that's the bottom, you know, that's showbiz, baby. And who bought yesterday? Who was buying these markets? Like Cardano at 91 cents or Solana at $1.71 or Bitcoin at like 91 or 92, probably those institutions. So they're removing those retailers from the table, replacing them with institutions, funneling that wealth up to the top. You know, pretty crazy stuff, you guys. I would like to recap a little bit with you guys how the last couple years has gone. Just kind of build like a timetable and a framework for what's been going on with the Fed and these interest rate cuts. So let's recap that. So in Halloween of 2023, so not last Halloween, guys, the one before that, we were in an environment where actually interest rates were going up. All we were reading about is when's the next rate hike? We got to do these rate hikes to get inflation under control. How many more rate hikes are there going to be? And then around Halloween of 2023, mysteriously, the rate hike talk started to wane. And then I would say by about January 2024, markets, even including lowly retailers like myself, were pretty well convinced that the rate hikes were over and we were going to be looking at interest rate cuts in an entire easing cycle coming. And we saw that last year, guys, from January of 2024 to December of 2024. Really, we saw Bitcoin run from like 28,000 to 100,000, you know, or 110,000, whatever it topped out at. And we were just climbing a wall of worry all of 2024, waiting for these interest rate cuts to come, because interest rate cuts make asset prices go higher. It's like one of the only real tried and true assumptions I can really apply to these markets is that interest rate cuts make rich people stuff and asset prices. So we're talking about NASDAQ, real estate, gold, Bitcoin, makes those go up. We had 3 interest rate cuts last year. They started in September. really markets knew ahead of time that those cuts were coming. So really the market started to inflate in like January of 2024 because it could smell those interest rate cuts coming. Remember, the market's always very forward looking. The stock market today is trying to price in where it thinks it should be like 6 to 18 months from now. So the stock market is a bit of a time machine. Markets are a bit of a time machine, guys. They're not lagging indicators either. They're very leading indicators. They're very forward looking. You know, the stock market doesn't really react, it anticipates. But I digress. So the market could smell these interest rate cuts coming last year at around January. By summer, we were really hoping for one, like, just give me a cut, just give me a cut. That's what the market was begging for. Fed didn't deliver on that. They waited till about the fall. And then they kicked off that easing cycle that has just begun, guys, with a 50 basis point cut on September 18th, 2024, followed by an additional 25 basis point cut on November 7th of 2024, and then a third additional interest rate cut of 25 basis points on December 18th, 2024. So guys, we were in a situation in Halloween of 2023 when we thought we were going to keep raising interest rates. By January of 2024, we could actually smell we were moving towards an easing cycle, not a rate hiking cycle. We were going to be cutting interest rates. By about fall of 2024, the market started to get their interest rate cuts. That really made them giddy. Markets kind of got ahead of themselves around Christmas, going into the end of the year. And then all those interest rate cuts had been kind of priced into markets. And then what happened in beginning of this month? Well, the Fed started pushing off those interest rate cuts. Maybe instead of 4 interest rate cuts for 2025, we're looking at 2. When the market goes from believing it's going to get 4 cuts to 2 cuts, in another way, that's like a rate hike in another, because the market is really already baked in a lot of cuts coming. Like, it's baked in 4, but then it only gets 2, so it has to give some back, and we've been seeing that all year so far, you guys. We've seen the Fed just kind of letting air out of the tires, letting those yields and rates move higher and put downward pressure on things like Bitcoin and the NASDAQ. But now, what's happening as of this morning? Somebody's buying bonds. They're driving that 10-year yield down. They're reinflating the bond bubble. The bond bubble getting fatter is kind of giving the green light for Bitcoin to get up there to back up to 100K, you know. So that's kind of what you got going on, you guys. You had a pretty deflationary 2023. Oh no, rate hikes. Then we had a pretty dovish easing 2024. Don't worry, the Fed's going to cut interest rates and hyperinflate your bags. Market baked that in by December of last year. And then now the market's like, what do you mean I'm not getting 4 cuts in 2025? I'm only getting 2? And what do you mean the 2 aren't going to start in March? They're going to start in June? And that's kind of what you're looking at, guys, as the Fed kind of adjusts expectations and manages expectations, and the market kind of reacts to it. So that's what you have going on. We're looking at, as of right now, 2 25 basis point cuts for 2025. Looking at a cut in June and then an additional cut in December. Now, if that cut, the first cut, if it comes in March, markets would like that. Markets would like these rate cuts to come sooner rather than later, and they'd like more instead of less. So if the market starts to think, hey, you know, inflation's going down on its own, we can have an interest rate cut in March. Well, and I expect these markets to keep inflating and the 10-year yield to drop back down below 4.5%, maybe grind lower or at least remain stable. And that's just kind of what I see happening. And then if the markets believe right now, which they do, that the next interest rate cut of 25 basis points is coming in June of this year, then if that gets pushed off to September or October because inflation remains sticky, well, markets will not like that. They'll begin to adjust expectations of fewer rate cuts later, and that will just kind of, you know, potentially send Bitcoin all the way back to like 75,000, or, you know, NASDAQ to give up, you know, maybe 10 or 15% or something like that. So be ready to buy these dips, you guys, if they come, if and when they come. I do expect somewhat of a volatile year. You know, last year, guys, the NASDAQ went up like 35%. I mean, that's insane. NASDAQ in a typical year should only be doing like half that, like 15, 17. So we're giving a little bit of that froth back, guys. Things got a little too giddy around Trump being elected and really being, you know, pro-business and pro-cutting rates. markets got really giddy on that. And now that we're a couple days away from Trump's inauguration, markets had to kind of blow off a little bit of that froth, that steam, those traders that were coming in around Christmas and they were just $1 short and a minute late. You know, we got to remove them from the table, and that's what we've done in January, is just kind of get rid of those weak hands, you know. So what I'm doing, you know, buying the dips, I'm still bullish tech stocks like Amazon, Google, Apple, Microsoft. You kind of get the idea. Tesla, sure. Rivian, if you got the appetite for a little bit more risk. I still like energy popped nicely today. Crude right now hanging out around 80 a barrel. Good to see crude back up over 80. Well, good for the people holding energy stocks. It's bad for core inflation, but that's a different topic for a different day. But it's good to see crude doing well. We remain constructive and bullish on crude oil, have since the inception of this channel. Still bullish crypto, you guys. I still like Bitcoin. Nothing's going to change there. Still like the meme coins. Nothing's going to change there. I still think Solana could be a $1,000 coin eventually, hanging out right now around 205. So, you know, you could potentially get a 5x there if Solana could just go up to 1,000 in the next few years. That'd be pretty awesome. And I think Solana will outperform Ethereum, guys, but not an Ethereum hater either. It's a $500 billion network. I don't see it going anywhere anytime soon. I like the ETH memes. You know, you kind of get the idea. XRP at 318. XRP today, crypto XRP went up 20% today. You know, the internet hates XRP so much. Guys, I was getting fills for XRP at like 25 cents, 50 cents a year ago. Wild. I only have like 750 of them. But, you know, I'm going to leave those till I'm pretty much retired. But it's fun to see XRP bubble back up and everyone tell you like, okay, now run away because XRP does this. It goes up and then it crashes again. And then looks like this time might be different. I don't know. Fingers crossed, you guys. A lot of XRP haters out there, though. But it's good to see XRP doing well. Sol, Cardano yesterday was 91 cents, back up over $1. Render was down in the 6s, back over 7. You kind of get the idea. So you've seen a little bit of action in crypto, liking it. Remain bullish crypto. Remain bullish precious metals, you guys. I like gold, I like silver, I like platinum, I like palladium. So there you go. Nothing has really changed for me. We've been bullish since the inception of this channel, and we've done really well. So, you know, pat yourself on the back. None of this is a buy or sell recommendation, though, you guys. I'm not a licensed fiduciary. I just come out here and tell you what I see going on and the moves I'm making. So there you go. Other than that, not really a whole lot else to discuss with you guys. We're just going to be keeping an eye on those markets, you know, keep everything going, keep it all fresh and relevant. I'm not going to leave you guys hanging. And in the next few days, if you're bullish, the things I'm bullish, then you want to see that 10-year yield come down to about 4.5%, maybe even below it. We want to see it moving down from where it's at right now, 4.65%. On the flip side of that, if you're bearish, then look for that 10-year yield to move up to like 5% and start really freaking out the entire global economy and freaking out all those assets out onto the end of the risk curve. So it's kind of like the bond market is in control right now, you guys. But here's a little cheat for you. The bond market's pretty much always in control. Okay, so there you go. The stock market, derivative of the bond market. Bitcoin's price, derivative of the bond market. Why? The bond market's a $200 trillion market. Bitcoin's a $1 trillion market. The debt market, the bond market, at 200 trillion, still 4 times the size of the US real estate market, you guys. So real estate does not tell the bond market what to do. The bond market tells real estate what to do. And that's why there's that old Wall Street adage, the bond market is never wrong. So, you know, we don't really like bonds in this channel. We don't like cash. We don't trade bonds. But it's important to understand bonds. It's important to understand how interest rates and bond yields work, because ultimately what happens in the largest market on planet Earth, that's what has the real knock-on effects all the way out to those tinier markets like Bitcoin, Solana, and pencil erasers, you know. That's really all I got for you guys for right now. I hope you find this helpful. Thanks for hanging out with me. Like, subscribe, comment, share, whatever. You guys are awesome. And let's just keep going, all right? Till next time.